Silver is sitting near $80 to $81 an ounce, down almost 30% from the January peak near $121, and on the surface that looks like weakness. But step back for a moment, because this is where most people misread the market. They see 4 straight down sessions, a stronger US dollar, oil surging after the US struck Iranian targets near Karg Island, and a Federal Reserve that may keep rates unchanged this week. And they assume the silver story is over. I do not see it that way. What we may be watching is not the end of a bull market, but the reset that often follows a move that rose too far, too fast. Wars are inflationary. Energy volatility matters. The Strait of Hormuz matters. Fed policy matters. But the deeper issue is that silver still sits at the intersection of monetary fear and industrial demand. The Silver Institute's structural deficit story has not disappeared. COMEX and LBMA inventory pressure has not magically vanished. What changed is the short-term macro backdrop. The dollar strengthened, rate cut expectations faded, and speculative heat had to come out of the market. That is why this zone feels so important. It is not just a price level. It is a test of conviction. And what happens next may tell us far more about the system than about silver alone. Now, if we step back and look beyond the headlines, the real pressure on silver right now may not be coming from supply or industrial demand at all. It may be coming from the currency system itself. Over the past few sessions, the US dollar has strengthened noticeably, enough to reverse part of silver's early year rally, even as the metal remains roughly 14% higher since January 2026. That matters because commodities priced in dollars rarely move independently from the currency that defines them. When the dollar rises, capital tends to rotate toward dollar-denominated assets. Treasuries, cash instruments, short-duration yields, and that pulls speculative flows away from metals. This shift has arrived at a moment when the Federal Reserve is widely expected to hold policy rates steady this week. While central banks across the Eurozone, the Bank of England, the Bank of Japan, and the Swiss National Bank prepare their own decisions. In other words, the market is not simply trading silver. It is repricing global liquidity expectations. A stronger dollar does not erase the structural deficit highlighted by the Silver Institute, nor does it suddenly refill inventories at COMEX or the LBMA. What it does is change the short-term gravity of capital flows, and when capital moves, metals temporarily follow. The question now is whether this currency pressure represents a pause in the trend, or the signal that the next phase of the cycle is quietly beginning. But here is where the story becomes more complicated, and perhaps more interesting than the price chart alone suggests. While silver has fallen back toward $81 an ounce, the deeper structure of the physical market has not relaxed in the way many would expect after such a correction. According to industry data referenced by groups like the Silver Institute, global demand has exceeded newly mined supply for several consecutive years, creating a structural deficit that did not suddenly disappear when prices dropped from $121 in January to the low 80s today. Inventories tracked through major exchanges such as COMEX in New York and the London Bullion Market Association, LBMA, remain well below levels seen earlier in the decade. Even as short-term macro forces, particularly a stronger US dollar and shifting Federal Reserve expectations, have pushed speculative capital away from metals. In other words, the paper market is reacting quickly to currency dynamics, while the physical supply chain moves far more slowly, and that divergence matters. Because when markets separate like this, prices often begin reflecting liquidity conditions first, and underlying scarcity later. The current weakness may therefore say less about silver itself, and more about the temporary dominance of monetary forces over industrial fundamentals. And if that balance begins to shift again through currency movements, policy changes, or geopolitical shocks, the reaction in metals could arrive much faster than many investors currently expect, and this is exactly why silver behaves differently from almost any other asset in the commodity complex. Unlike gold, which functions primarily as a monetary refuge, silver lives in two worlds at the same time. On one side, it is still a precious metal, historically tied to inflation hedging, financial instability, and the search for safety when geopolitical tensions rise. On the other side, it is a deeply industrial material, embedded in the infrastructure of the modern economy. from solar panels and semiconductor components to advanced electronics and energy storage. Silver sits inside the technologies driving the global electrification cycle. That dual identity creates a strange tension in the market. When macro forces dominate, like a stronger US dollar, cautious Federal Reserve policy, or tightening financial conditions, silver can fall quickly alongside other commodities. Yet when industrial demand accelerates, or investors begin repositioning for inflation or geopolitical risk, the same metal can rally far faster than gold. This is why the recent move from $121 in January down toward the $80 range feels dramatic, but not necessarily unnatural. Silver is rarely calm. It expands and contracts with both the industrial cycle and the monetary cycle simultaneously. And when those two forces eventually begin moving in the same direction again, the price response historically becomes far more powerful than most investors expect. And when you connect all of these threads together, the silver market begins to look less like a simple commodity trade, and more like a reflection of three powerful forces moving beneath the global economy. The first is the strength of the US dollar, which has recently pushed higher as investors reassess monetary policy expectations ahead of this week's Federal Reserve decision. The second is the rising layer of geopolitical uncertainty, particularly the ongoing confrontation between the United States and Iran after strikes near the Karg Island oil export hub, an escalation that has already pushed crude prices roughly 12% higher over the past month, and revived fears around the stability of the Strait of Hormuz. The third force is the policy outlook itself. Whether central banks from the Fed to the European Central Bank and the Bank of England maintain restrictive conditions longer than markets once expected. Silver now sits directly at the intersection of these pressures. It responds to currency strength, reacts to geopolitical risk, and ultimately reflects how capital moves through the global system when uncertainty rises. In that sense, the recent volatility around $80 to $85 per ounce may be telling us something larger about the moment we are living through. Because when currency dynamics, energy markets, and central bank policy begin colliding at the same time, commodities rarely remain quiet for long, and this is where the market begins to reveal something deeper than a simple price correction. Silver does not move like a typical commodity, because it carries two engines inside the same metal. On one side, it behaves like money. Investors turn to it when inflation fears rise, when geopolitical tensions escalate, or when confidence in fiat systems begins to erode. On the other side, it is an industrial backbone of the modern economy, quietly embedded in solar panels, semiconductor manufacturing, electronics, and the electrification of global infrastructure. That dual identity explains why the move from $121 in January down toward the $80 range today feels so dramatic. The monetary side of silver is reacting to a stronger US dollar, and expectations that the Federal Reserve may keep policy rates steady longer than markets hoped. Meanwhile, the industrial side continues to be supported by structural demand from renewable energy and advanced technology sectors. These two forces rarely move in perfect synchronization. Instead, they pull the market back and forth until a new equilibrium forms. When monetary tightening dominates, silver can correct sharply. But when industrial demand and inflation expectations begin aligning again, the same metal that falls quickly can rise even faster. And that tension is exactly what the market is wrestling with now. And when we step back from the daily price swings, the silver market begins to revolve around three forces shaping the broader financial system. The first is the US dollar, whose recent strength has redirected global capital toward dollar-denominated assets, just as investors reassess expectations for the Federal Reserve's policy path this week. The second force is geopolitical risk, particularly the confrontation between the United States and Iran after strikes near Karg Island, an escalation that has already helped push crude oil prices roughly 12% higher over the past month, while raising concerns over the security of the Strait of Hormuz, one of the world's most critical energy corridors. And the third force is the collective stance of central banks, from the European Central Bank to the Bank of England, the Bank of Japan, and the Swiss National Bank, as policymakers navigate the delicate balance between controlling inflation and sustaining economic growth. Silver now sits at the intersection of these pressures. It responds to currency strength, reacts to geopolitical shocks, and mirrors how capital flows adjust when uncertainty rises. In that sense, the metal trading near $80 per ounce is not just reflecting supply and demand, it is quietly echoing the tension within the global economic system itself. So where does this leave us now? If you look at the charts, silver hovering near $80 to $80 an ounce might appear uncertain, even fragile after the dramatic fall from 121 earlier this year. But markets rarely move in straight lines. And moments like this often say more about positioning than about value itself. Technically, the metal now sits in a zone that traders are watching closely, around $75 as a key support level, while the $84 to $85 range represents the first layer of resistance tied to short-term moving averages. A sustained move back above that level could reopen the path toward $90. But such a shift will likely require a catalyst, either a weakening US dollar, a change in Federal Reserve expectations, or a renewed wave of geopolitical uncertainty linked to tensions between the United States and Iran. Until one of those forces changes, silver may continue oscillating inside the $75–90 corridor, reflecting the uneasy balance between macroeconomic pressure and structural demand. Yet markets often build their foundations during periods that feel the most uncertain. And if the broader currents of currency, energy, and policy begin shifting again, the quiet consolidation we see today may ultimately prove to be the stage where the next chapter of the silver market begins.